Good evening, Damit. Hello?
Hello, sir.
Can you hear me?
Yes, sir. Yes.
Yeah. I think my camera is giving a problem. Voice is okay, no?
Voice is okay, sir.
Shall I increase now?
Sorry?
Shall I increase the not necessary, no?
No, sir. That's good.
You can clearly hear me, huh?
Yes, sir. Yes.
Okay. Thank you. You allow me to share the screen?
Yes, sir.
Okay.
Yes, sir. No, okay.
Can you see me my screen?
Yes, sir.
Right. Uh, Now okay, huh?
Okay, sir.
Now you can see the slide.
Yeah, yeah, sir. The presentation. See,
Yeah, okay. Thank you.
sir. Before session start, I will introduce you.
Okay.
Okay,
Thank
sir.
you.
Thank you.
Shall I keep the presentation slide? Okay, open, no problem.
Okay, sir.
I know they will come at 2:15, but I always enter into the Zoom 45 minutes, 12:45, 1:45. Damit, can you see the Excel sheet now?
Yes, sir.
Right. Okay.
Good afternoon, everyone. I am deeply honored to introduce our highly respected resource person for today's session. Dr. WMKG Anura Wickrmasinghe is the bursar of the Open University of Sri Lanka. He is a highly qualified and experienced professional in the field of accounting, finance, and administration. He holds a Bachelor of Business from the University of California and a Masters of Business Administration from the Postgraduate Institute of Management, University of Sri Jayawardenepura. Dr. Wickramasinghe obtained his Doctor of Philosophy from the Management Science University of Malaysia. Professionally, he is a licentiate of the Institute of Chartered Accountants and a member of the Chartered Institute of Public Finance and Accountancy in both Sri Lanka and the United Kingdom. He is also fellow member of the Public Finance Accountants of Sri Lanka, a recognition awarded to professionals who have demonstrated excellence and leadership in the field of public finance. Dr. Wickramasinghe assumed duties as the bursar of the Open University of Sri Lanka January 2040, becoming the seventh bursar of the university. Before joining University of Sri Lanka, where he gained extensive experience in university financial administration. Throughout his career, Dr. Wickramasinghe has contributed significantly to promoting financial discipline, transparency, and effective resource management in the higher education sector. We are truly honored to have him with us today, and I take this opportunity to sincerely thank him for accepting our invitation. Sir, we warmly welcome you, and now the session is over to you. Thank you.
Thank you, Damit, very detailed explanation. Thank you very much. And
Thank you.
can you hear me? Or no problem, no?
Yes, sir.
Good afternoon to all of you.
Good afternoon.
So first off, we move on to our session one today. Can I know the profile of participant? Especially what is your designation and the field of expertise? One by one, can you tell me? Shall I ask? Then you can. There are 9. Right. Mr. Gayan Sanjeeva?
Hello, sir. Good afternoon.
Yeah, good afternoon. What is your designation and
Yeah, I'm working as an order and delivery manager in Ericsson KSA branch, Saudi Arabia.
I see. Nice to hear. And your field is not accountants, yeah?
Now, supply chain and logistic.
Okay, okay. Yeah, just I should know who are my participant. Mr. Rahman?
Yeah, good afternoon, sir. This is Fasilur Rahman. I'm working as a procurement executive in oil and gas sector in Qatar.
Tata. You are not an accountant, huh?
No, I'm a procurement executive.
Don't worry, we will learn accounting within this second. Right?
Yeah.
Right. Mr. Loganathan?
Yes, good afternoon, sir. I am working as a chief accountant, Department of Health.
In Sri Lanka?
Yes,
Well, your field is
accounting.
accounting. You are right. Are you an accountant?
Yes,
Then you it is easy for you.
thanks.
I think you have now Mr. Mohammed Subani.
Hi, sir. I am in Dubai. I'm working in a semi-government sector in Dubai, cable manufacturing company as a order management specialist, especially for logistic and supply chain.
Your field of expertise is not accountancy.
Not economic, basically electrical engineer. Moved to supply chain now.
Very nice. It's not a big deal. Right. Mudita? Mudita? Miss Mudita or Mudita? I don't know. Mr. Sanjeev Disanayaka?
I am Sanjeev Disanayake. I am working in Sri Lanka Ports Authority as a Deputy Chief Engineer Development.
Right. Most of the engineers.
Yes.
They can understand accountancy faster than us. Okay, anyway, what I want to highlight you all, I am not going to teach you pure accounting within this shorter period, but you should understand the concept. That's what I am expecting. Last time also, I had the same around 18 students. So at the beginning, I told, now you are deputy engineers, the deputy managers, but when you are in the board, you should understand whatever the story explained by the accountants, finance executives, or managers, finance managers. So I think again join Mr. Nuan Veeraman.
Yes, sir.
Oh, what is your field of expertise, and
I'm sorry.
what is your field of expertise?
I'm working as a maintenance officer.
Where, in Sri Lanka? Or?
Yes.
Right. No, just I was checking the profile of the students.
Okay.
So therefore, I will explain only the concept, and we are not going to create formulas, how to create formulas. So just whatever the accounting and finance knowledge applicable to your procurement and supply management. That's what I am trying to do. Is it okay, or you need the accounting, public accounting and finance? So if you take investment and project appraisal, so the very simple techniques I am going to talk with you. So therefore, even though you are from the engineering, management, whatever, supply chain management, that will be a common to all. But I know if there are accountants, they will see this is not up to the level that they are expecting as a accountant. So because I can't be a accountant here, I am a finance man. I can teach you very tough technical things during this period. I'm also chartered accountant. So therefore, I will see as a non-accountant, non-finance accountant, or non-finance person. I will talk like that. So during this 3 or 4 sessions. So shall we move into next slide? Now, all of you know what is budget. Maybe in your company, you have a budget. If it is a government institution, you need to prepare a budget as a head of department or deputy general manager. So you need to prepare a budget. So budget is everywhere. So now it is a plan for the accomplishment of programs related to objective and goal within the definite time. For example, Sri Lanka, now we are going to present the new budget to the parliament. Even as a government institution, university also, we have already sent our estimate to the government treasury. Now they are assimilating everything and preparing the final budget for the whole country. Now, so therefore, please listen to the budgets speak. As you all know, I think in any parliament, this appropriation bill is passed in any country. And they will vote for the budget in 3 occasions. First occasion is generally they will tell what is the total revenue, what is the total expenditure, what is the surplus or deficit. But at the second level of reading, they will read the budget headwise. We call it head. For example, higher education and education sector head is 218. So this is the word we used, heady, right? So all the cost to be incurred in the year 2026 will be detailed in that budget. So third time they will go into department level in the parliament, and after getting approval of the parliament, they will execute the budget. Most probably, as you all know, even government organization, we should have a corporate plan as much as similar to the private sector. So, and there's an action plan for the 2026. And based on that action plan, we prepare procurement plan. So in preparing procurement plan, the procurement officers, supply chain managers, they can help in the finance division. So that is the way we implement budgets. So therefore, you need to understand what is budget in a government setting or in the private sector. So then there is a process in capital budgeting. So capital budgeting is the process by which organization evaluate and decide on major long-term investment or projects. Here is concise overview of the capital budgeting process. Now, so you can see what is the process, capital budget. Now, this is very critical decision to be taken by the government or private sector, because this involves huge investment. You can't reverse this decision, right? For example, if you set up a port like down south in Sri Lanka, it is 8 billion, 9 billion, 10 billion. So that investment huge in anywhere in the world. A capital investment cost loss. Therefore, you can't reverse that also. Later you find that many vessels cannot enter into the huge port you created. So then, whatever you invested in huge project will not be benefited to the country. So therefore, now even private sector, they invest in huge project in all hotels. For example, here I have given something like infra, roads, ports, highways, toll power plants, public services, hospitals, schools. So something like that. So we have to identify first, then gather and analyze data. What is the cost? What is the lifespan, expected and the social impact. So, for example, I will tell you in the last, everybody knows that Sri Lanka faces a debt crisis, and we were bankrupt, and government central bank disclosed that we are already bankrupt. So that what is the major reasons for that? As a procurement specialist, you can read the history everywhere in the internet. Now, the major cause, we invested huge money on the infrastructure projects. The return is not coming very soon. You all know, if you develop a hotel, you will invest billions rupees, but will you get the money return like if you invested in FD and getting interest monthly? So this is totally different. So as you all know, capital projects, it takes time to give return, because first we have to do the project during 4 or 5 years. After that, slowly start the revenue generation activity. So we had a Mattala airport and big investment. I think still we can't attract planes to that, unlike Bandaranaike International Airport. So we should have strategies to attract international companies to come to down south. So they should have checked this before investing in huge capital infrastructure project. Even highways. Now all highways stopped during because we don't have money to invest. And another thing is, now if you take a loan from ADB, World Bank, and big bank like that, they will charge only 0 to 2%. But from where we got money during that bankrupt period, we got a loan from HSBC at 8%, 7%. So can you imagine that ADB and the World Bank, the Japanese bank, they are giving very low rate, but they will ask a lot of questions. When you want to invest in infrastructure project, they will ask what are going to do the people affected, what is the benefit to the country. They have to showcase everything. But country like China, I don't think that it required. So anyway, I'm not blaming any government, but what I'm telling the reason why we bankrupt. Even if you take an overdraft from the bank and invest in a property, you will end up, because you have to settle the loan, whatever the interest and the loan repayment from next day onward. But government project, they have a grace period around 3 years, 5 years. So will you construct a house taking bank OD? You don't. You will go for the loan, 15-year, 10-year loan at a low rate. So in Sri Lanka, what happened, when they invest in infrastructure project, they had obtained this loan at a higher rate. You can check it. So even I think there are students from Saudi Arabia. You can check how is your government, how Sri Lankan government or any other country collapse. you can get some idea, right? So first we have to, before investing, we have to see and what is the initial cost, how long it will be operated, and taxes, foreign aids, right? So then the third, evaluate investment option. So we have a lot of investment appraisal techniques. I'm not going to touch all, but most essential financial evaluation technique is the, I think, net present value calculation. What is the real value of the money? You all know the rupee in today is worth more than rupee you are getting after 1 year. That is the principle. Because of inflation. So that I will discuss in detail, right? And next, cost benefit analysis. You can read all these things in the internet. We have enough details in the web. So if you type cost benefit analysis in the Google, you will get everything, right? Then economic rate of return. These are the technical jargon. Don't need to keep in everything in mind. So, but I have to teach you. I have to give the at least concept, because whenever you see these things in your reporting, then you will understand. Even if you go through the financial statement of your company, your organization, your ministry, your department, then understand, right? Right. Economic rate of return also, the way we can calculate huge infrastructure project, how it contributed to the society. For example, now if you are investing in a bridge connecting to, now I think China introduced the world longest bridge, right? And I think travel time reduced to 6 minutes from hours. So like that is the benefit as a public we will get in the future. So there may be social factors, happiness, all those things you can include in the economic rate of return, right? Social return on investment. Now you can read this one also. If you assume new highways connecting the rural area to the main city, they can bring their whatever the goods to sell in the city area. So yeah, their transport easiness and happiness, because you are very happy, you can reach the whatever destination within a half an hour, 15 minutes, depending on the where you. So that is the social return. These things you can put some financial values and assess. Now after analyzing your projects using investment appraisal techniques, we can select the best project. For example, now if you have 2-3 projects, you can see what is the benefit. You can select the highest benefit project to go ahead, right? And project which you give the cash flows at the very beginning, so you will move into that, because you can pay back your loan if you are getting your income Now we are even under IMF guidance now. So they will say what to do. And as you all know, we have come across the huge burden of debt, but now we have a free time. But I don't think that after 2028, we have to pay back all the loans. We have to pay back start the payment of installment plus interest from 2028. So we have a grace period up to that. So during that period, actually the Sri Lanka can increase the foreign reserve. Now it is around 8 billion. So they are targeting to bring it to the 15 billion, almost double. So anyway, these are the things you just to understand. Now our duty is to select the best project. Here says, consider alignment with national development plans, evaluate political priorities and public opinion, assess environmental impact, consider regional balance and the equity. Now, Mahawali project, it was planned to do in 35 years. But at that time, within 5 years, they finished. Now you can see during some period, the reservoir don't have water. So something like that. I mean, that the priority, evaluate political priorities. So they want to go ahead with this huge project with political priorities. So now we are suffering. So now after selecting best project, you need to see from where you are going to get the money. That is secure funding and approvals. That's why I told you. Actually, I was in the Ministry of Provincial Council and Local Government for 2-year period as a financial analyst. I took leave from the university and worked there. Now, at that time, I saw we were obtaining a loan from ADB, World Bank, Japanese bank, and also HSBC. So private bank. But I saw the rate of interest was very high in the HSBC loan. It went up to around 7%. But if you move to the ADB, it is around 1.5%. So you can see the impact. So we need to secure funding and approvals. So all these were approved by the parliament anyway. Obtain parliamentary approval if required. Secure funding from national budget. National budget mean we have a department called national budget, and they are approving all the projects. We need to get the approval. Even as a university, we are trying to develop a 6-story building for the management faculty. So that costs around us 881 million. So that project, we need to get the national budget approval, Department of National Budget. And the loans comply with the public procurement regulation. Now, this is the area where you are very important. Now, we need to see, we need to know all the public procurement regulations. So now in Sri Lanka, we have changed our guideline from 2024. We have a new guideline. So all the officers, managers in the procurement field, definitely they have to read and understand the new guideline. Procurement guideline 2024. So that is for goods and services. So then because you have to comply with these regulations. So there are limits given in that particular guidelines, how much you can go ahead as a department, as a university, and as a ministry. So after secure funding and approvals, then we need to implement the project and monitor. So many ministries, they have a project management unit. Even Treasury, they have project management units, because they have to see the progress or whether they are implementing the project, because I think they will come and review your activity. For example, even IMF, they are coming every biannually, 4 months, after 4 months, they are coming and evaluating, because we got approval for $3 billion US, but that is paid last time around 338 million. So each and every tranche or installment, they will come and evaluate whether we have followed their instructions, whether we have reached the whatever target given by the IMF. So they are continuously checking where we are. So same way, even government project, we need to chase behind. So for that, they conduct regular audits by this project management divisions in everywhere. I think even huge companies, the multinational company, they have project management units, because they are also investing in huge project. Even John Keel's investing huge. They are constructing hotel in the sea. So therefore, so you see now billion of rupees are invested. So therefore, we need to monitor all these projects, because heavy burden to the government, heavy burden to the again public. So therefore, they are very keen on implementing and monitoring the project. Even during that 2-year period, I was in the project monitoring unit, project monitoring management units or whatever that is. They are in all the ministries, especially education, health, ports, road. That ministries, definitely they have a project management units. Now, post-implementation review. Now we are giving a rosy picture at the beginning of the project. After this project, we will elevate the poverty, increase the social happiness, increase the social condition, whatever things you said at the beginning, you promise. And we have to see the after implementation, which is called, even World Bank, they are coming. Huge, if they invest in, give loan, if they provide loans for the huge projects, if the project is for 5 years, they will come and see, which is called post review, similar to the post implementation review. They will come and assess actual outcomes, whether we have reached the targets, whatever you promised at the beginning. You see, evaluate impact on economic indicators and public welfare. Now, whether life condition is better than what were earlier. So even any country, World Bank is going there and evaluating. Now, we had a projects, education project, that after 5 years, they came. They came and they visited all the places. And you can't tell whatever you want, because they will ask questions and they will check. Not they will depend on our report. They will independently review and give the report to the World Bank. And now, then next funding is, if you have violated the condition, whatever set up at the beginning, then definitely they will not give money for the next project. They will sometime, some countries, as I remember, Bangladesh, or I can't remember really the country name, but they stop funding. So you can check the internet and get the information. So after the post-implementation review, they have decided not to fund that particular country because they have breached the target set up at the beginning. The last one, transparency and accountability. So even to achieve this transparency, some government organization, they have created a audit committee that comprise of officers, public, and representation from all the stakeholders of the project. Then they are coming and investigating affairs. So then we can say we are very transparent and giving all the information to the committee. It is not like audit committee in the company or private company or government auditor. It's not that audit committee, but we call it audit committee, which comprises of all the stakeholders, representation from all the stakeholders. They, as a group, they will come and evaluate the our affairs. Then they will tell, yeah, they have followed the guidelines and no corruptions, like that. They will report. So now, now this is for 2024. Just I want to show you a budget estimate, how we are preparing budget state estimate for a institution like us, like Open University of Sri Lanka. So now we are preparing, we have already sent the budget, because September we started the budget. Not only Open University, all the government institution in Sri Lanka, they prepared the budget. We need to prepare triennial budget, even 3-year budget, and send it to the ministry, and ministry will send it to the treasury. And now I think everything finalized. In November, I think they will present the budget to the parliament, right? Now, I will never ask in the exam, please prepare a budget. That will be end of your life. So you understand. So you see, can you all see? Mr. Mohammed Subani, can you check? Can you see?
Yes, it is visible, sir.
Okay. Now, this is the way our Sri Lanka is preparing budgets. So, as I told you, you can see budget. This is the example for 2024. Head number. So, under 214, that is the way they are giving the expenditure code. That is University Grant Commission. Under the University Grant Commission, we are getting money. So you can see what is, because triennial budget for 3-year period, we have prepared 2024, 2025, 2026. 25-26 at that time, it was projection. Now we have already sent the budget 2025. and projection for 2026, 2027, 2028. Because we are in 2025. So you can see. Now, just for understanding, now in the budget, we have some revenue other than the other universities, but we have revenue. And also the expenditure type is recurrent and the capital. That's all. So some organizations, they have only expenditure, very small revenue. But you can see the Open University is having revenue because we don't get all the expenditure from government. We get only permanent staff salary. Other things we have to earn. So therefore, we have not hindered the treasury. We have not asked money for everything. So that is the rely from actually Open University is not bothering too much to the treasury, right? But if you take other department, they will ask what all the money from the treasury, and you all know, like railway, transport board, making huge loss to the treasury. Treasury has to cover all the losses created by this institution. So anyway, this is just for understanding. You can check the internet again. If you type the budget estimate Sri Lanka 2025, everything is there, right? The major expenditure category is recurrent and capital. Right. Specific consideration, yeah. Specific consideration for Sri Lanka. So it should be aligned with Sri Lanka National Development Strategy. Consider debt sustainability given Sri Lanka recent economic challenges. Right. Focus on projects that can boost export and reduce import dependence. So these are the specific considerations for Sri Lanka. You can read. So balance urban and rural development. That is a duty owed to the Ministry of Provincial Council as well. So we have implemented a lot of projects in order to eradicate poverty. So if you see the Western province is flourishing, but I will tell you now, within the Western province, you can find the pockets having poverty more than the rural area. That is another issue, because we think always Western province people are having money, having access to everything, but there are vulnerable groups within the provinces also. They are very worst in situation. They are experiencing a lot of difficulties than the rural people. Anyway, now these are the specific consideration for Sri Lanka. Now I have given simplified way capital budget process steps. So you can read. So this is, I think, common to private sector as well. It is not only for the government. Okay. So we will move to the project techniques, project evaluation techniques. First one is the net present value. This, I think, we need to learn. we need to calculate the present value. So only one formula is to be used. Therefore, no, don't worry about that. I think most of engineers, they know that net present value. And all accountants knows this very well. Because in the exam, I need to, it is easy for you to get marks, because if you attempt completely, you will get the money, the marks. If I allocated 20 marks for the sum, if you complete correctly, you will get 20 marks. So therefore, I last time also I put 2 sums. So most of them very well attended. So therefore, these techniques, even you can search web and learn from friends, learn from get together and learn. So this is the big thing. It's a very small calculation. So we will see in the time to come, and we will do some calculation and understand. So the present value of future cash flows, actually what we are expecting this, now we can, whatever the cash to be received in the future. For example, I have invested in the project this year, 2025, and I am getting money 2026, 2027, 2028, 2029. So all the monies in absolute terms, we can bring them to bring them to present condition. What is the value of today? Then you can compare with whatever your investment, because investment is today. Today you need to invest 400 million or whatever amount, but you will get the return in the future. So you can bring the future cash flows to the present value, then compare. So that's what we are going to do. So generally it says positive NPVs are considered favorable. Now, don't worry about calculation. Don't think that this is a big calculation. No, very simple calculation. So I will check only that NPV, because as the syllabus says, you have learned accounting and finance. At least you should know very well the most wanted techniques. And many times, many people apply these techniques, net present value, for the budget evaluation. So therefore, we can discuss in the future. Right. All are having calculator. Did you bring calculators? All are silent. Yes. Miss Ganga, you have the calculator? Right, this is the formula you have to learn, very grade 5 formula, very small formula. Present value equal 1 divided by 1 plus r to the power n. So I have given the example, 5,000 payable in 2 years time, r is 17%. So you need to pay 5,000 each year. It is been 10,000. So you can see the present value of that payment today. So this is where you can bring the future cash flow to the present value. So anybody can tell me, who can tell me what is the value of 5,000? How do you get it? The interest rate is R mean, I will explain you the PV mean present value. 1 is the amount what we are going to discount, and 1 plus R mean discount value, discount factor. So we use discount factor. Simply understanding it may be inflation rate or interest rate, bank interest rate. We can take as a R
3,652.56.
for the first year.
No, second year, end of the second year.
Right. So you see, now what is your good name?
Mudita.
Mudita, actually now you can see, even others can calculate, just you divided 5,000 by 1.17 into the power 2. Isn't it?
Now, first of all, I have discounted the interest rate just after second year end. And discount factor was 0.73051.
Right.
Divided by 5,000. Then we will end up with 3,652.
Okay, great. Now others also can just see. So if I can show you the right. This one is an example. So the Open University manufactures whatever the things. Now in the year today, year 0 mean today. Year 1, end of year 1, year 2, year 3, year 4. So these are the cash flows. I have given you the cash flows. So what is the rate? What is the rate we have used? 12%.
Here we use 12%, no?
Yeah, I think 1.12. Yes, 8.93. Now it has given here discounting factor. So please calculate and see whether this is correct. So I will explain for the non-accountants and non-financial managers. So you can see today you need 900,000 to do the project. This is actually a real project. We were manufacturing dry fruits. We can banana and pineapple. We can dry it and keep for future. Right, correct. Right. Sorry. Can you all attempt, please? Please work out all and see whether my calculation is correct. Now in the year 0, always you take 1 because 1 divided by, because you are in the year 0 at the beginning. So in the second year, year 1, you have to find this discount factor. How do you get that? 1 divided by 1.12. So check whether it is you are getting 1 divided by 1.12. I gave you the formula at the beginning. Present value equal 1 divided by 1 plus r to the power n. If anybody is not getting this 893, tell me. Year 2, 0.797, because you divided 1 divided by 1.12 to the power 2. So then you multiply it by that discounting factor with the cash flows. So you can see year 1, you are getting 300,000, but today's value is 267,900. So that is the figure we should compare with whatever our investment today. Now, therefore, you can see, for example, insurance company says we are giving 1 lakh after 15 years. But if you check the value today, it is 3,500 or something. You can check. Whatever the years, you can put it for the formula and get the discounting factor and then apply. Anybody is having trouble, please talk to me. Don't be silent. If it is not clear, I can tell. This is you have to learn very well. This is actually even in your board or director board, you need to understand the report given by the finance people. Because this is important for the procurement also. I will show you another example, how it will help us. So please attempt. In the year 0, 1, it is always you should put 1. Second year, 1 divided by 1.12 to the power 1. Second year, 1 divided by 1.12 to the power 2. Third year, 1 divided by 1.12 into the power 3. In the Excel also you can use, there's a I hope all are attending. Then I will get one by one again. There are 10 participants. Miss, I think Miss KPM. I don't know, I can read your name only. Did you understand KPM?
Yes,
No,
sir, but
tell me.
not very much.
Huh?
No, sir.
So now what
Sorry,
we
sir,
are
I'm having a
doing,
cough. That's why.
sorry?
Sorry, sir, I'm having cough. That's why.
Right. No, but if you have a cough, but you can listen to me very well,
Yeah.
right?
Yeah. Okay.
Right? Now actually we have a cash flows. You can see this is a project, dry food project. At the beginning today, we need to invest 900,000. So we invest. In the year 1, we are getting 300,000 because we know profit is 30 rupees per unit and into 1,000. You think you can calculate the profit you earn, profit you will earn in the future. So we assume in the year 3, 1, 2, 3, we are getting 300,000, and year 4, 400,000. This is not actual figures, and this is estimated figures. So this is the now situation. Now you can see, if you add the absolute value, 300,000, 300,000, 600,000, 300,000, 900,000, plus 400,000, 1.3 million. So you can see 400,000 is the profit in absolute term, in financial term. But when you go to the NPV calculation, you see only 75,000. Why? The future money you are getting in the future is lesser value as of today. 1 rupee you are having today is worth than the 1 rupee having after 3 years, 4 years. So this concept we need to learn anyway, because this is the only area I am going to test in the exam. I'm frankly telling, therefore you need to understand. If somebody not clear, so tell me, I will make clear. So this is in rupees term. In Saudi Arabia, I don't know, Kuwait dinar or whatever, dollar, whatever you put in your currency term. I have never mentioned the currency here. In some I have said rupees. It may be dollar, whatever, Kuwait dinar or whatever. So now you bring because you are going to, you can't compare this 900,000 with the money you are getting year 1, year 2, year 3, year 4, because 2 different years, 3 different years, 4 different years. So therefore, I need to bring this to the present value today. So then you can compare with your investment. So this we get the discounting factor. Just simple formula. Your present value formula is 1 divided by 1 plus R. R means 0.12. So you add 1.12 because R is 0.12. So 1 divided by 1 plus 0.12, it means 1 divided 1.12. You divide and see. Then you will get this discounting factor. There's a table also. For the exam also, I think discounting table will be given to you, or you can find the factor. If anybody is not getting the discounting factor, please let me know. I may be wrong. Or any person who already checked, let me know my answer is correct.
So the answer is correct. So I just want to know that the cash flow you mentioned year 1, year 2, year 3 is like an assumption only, right?
Yeah. This is definitely. It's an estimate.
Okay, sir.
We don't know whether we will get, we can sell the product, we can get the income, but this is the rough estimate. It may be go up or go down, but for the time being, this is the income we are projecting. Actually, this is projecting.
Okay, sir.
Right. This is the same technique we can use. I will come to that because if you are in procurement, you will get 2 bidders in the same value, financial term. Then how can you compare? So that type of situation, you can use the NPV and check the present value of future cash flow. For example, today you are buying an asset worth of 1 million and you have to pay maintenance for 5 years. Sometimes these people may ask maintenance payment in the year 1. Sometimes they may ask after the year 3. So then you can't compare. So then you need the net present value calculation. You have to bring all the payment to the today value and compare. That's what I am going to do actually. This is pure finance, but we will use these financial techniques to evaluate procurement decision. Okay, thank you, Ganga. I think she has sent a message. NPV is okay. So before me moving to the next slide, please, if you don't understand anybody, please feel free to tell me. If you're silent, I am thinking you are expert and you know everything, then it will be a disaster in the exam. So, anybody feel it is difficult? Don't worry, you are executives. Sometimes you may know him better than me. So, but tell me, if it is not clear, then I can repeat. Shall we move to the, shall I ask from the Saudi Arabia? Mohammad Subani. No more there.
Yes, it's correct, sir. 75,000. I got the answer.
Right. The way I talk, it is clear to you, Mohammed?
Yes, sir. It's correct.
Okay.
I can understand. Yeah.
But your people talk, I can't understand. Very difficult. They are talking very fast. Anyway, Mr. Nuan Veeraman. I think they are. Mrs. Anjiva?
Yes, clear, sir.
Clear. Thank you. So if anybody is having issues, so you can refer, you get together. Anytime you can email me, I am responding. So this concept, very simple concept. This is the technique I am going to check in the exam. That's all from financial side. If you want more, tell me. I will make a little bit advanced sum also. If somebody feels this is very simple, also I can change. Clear, sir. Thank you. Thank you for the response. Right. Shall I move on?
Yes, sir.
Okay. Thank you. Now you can see, if you add 300,000 in the year 1, year 2, year 3, 300,000 altogether 900,000 plus 400, 1.3 million. So if you deduct 1.3 million and 900,000, profit says 400,000, which is wrong. It is only 75,000 because we assume discounting factor of 12%. That may be equivalent to the inflation rate in that country or cost of capital. So we don't think about cost of capital now. In the exam, I will give the discount factor. Don't worry. So that I will give just only you to calculate and add that percentage to the formula. Formula is also very simple. 1 divided by 1 plus r to the power. Power n. Power n means the year number of years. Year 1 or year 2, year 3 or year 4. So then you arrive the discounting factor. Just multiply that discounting factor by cash flows. You can put this way also, other top to down also you can put. No problem. The way you want, you can put. But this is the way most people are using. So therefore, I have put like this. So it is very clear now. Cash flows, present value is 975,000 plus minus 900,000, you will end up with the 75,000. This is not absolute figures. This is financial terms. No. In money term, it's a rupee term or dollar term. No. This is discounting factor applied, and we bring all the cash flows to the today's value and compare. IRR. Actually, IRR mean the rate of return where NPV is 0. So this is there's a formula to calculate. So that is also you can learn. It is not difficult. A formula is given here, but at least you should know what is IRR. At least you should know when the project becomes 0, NPV 0, that is the IR, internal rate of return. Right? This IRR definition is given because here it is almost similar to, because 75,000, if you increase this by 1%, it means if you discount this by 13%, definitely you will end up with the NPV 0. I don't know, maybe. Then we can take IRR is the 13%. This, when the NPV becomes 0, that discounting factor is called IRR, internal rate of return. There's a formula to calculate. So this is the formula. NPV equal, you can see 1 plus IRR to the power. So you can try it. I'm not going to ask in the exam. Only for understanding. You should know there is a technique called internal rate of return. That's all. And how it is calculated, I don't want. Payback period. This is a very simple. You invest today 100,000 or 1 million. If you get that 500,000 each in the next 2 years, your payback is 2 years. Because you invest 1 million, you got 500,000 each in the next 2 years. So your investment is recovered within 2 years. The shorter payback periods are preferred. So if there are 2 projects, we will select shorter payback period because you are getting money quickly. So getting money quickly is better than getting money late, because if you can recover your investment, whatever your investment within 2 years, fine. If it takes 4 years, there are a lot of risk factors. Like Nepal, Generation C people came to the road, you stop the all the Facebook, they become tigers and ruin the country. So if the payback period is 3 years, very difficult. So sooner if you can recover, that is better. In the investment point of view, anything can happen. What happened to the Bangladesh? It was developing very well with the IMF support and everything. I don't know. So therefore, the risk is there for you. So the payback period mean, so how long it take to pay back? Payback. It means reverse your investment. So this is simple. We will have a small calculation, and so you can see initial investment payback period is initial investment 100,000, annual cash flow 500,000. If you divide it by 100,000, answer is 2. But there's a assumption, the constant annual cash flows. So here it is given. Let's say you are considering an investment. The following details: initial investment 50,000, annual cash flow 10,000. So definitely I can say payback period is 5 years. This is again in financial terms, not in discounting factor, no discounted cash flows. Actually, this is wrong according to them. Now, if you can get the discounted cash flows over the 5 years, then you can take the discounted cash flow. It means payback period, discounted payback. That is better than the payback period, simple pay. But if you have 10 projects, just you go through the, but again, there's another mistake. We don't see the value in rupee terms because payback period, for example, this is 50,000 into 10,000 is 5 years, even 500,000 into 100,000, 5 years. So which 5 years is better? 500,000. Because you are getting big money to your organization. You know, these are small calculations you can do. And the final day, I will discuss the question paper, not exactly one, but which is similar to the paper, and work with you. So don't have headache. So it won't be a 100% different to the whatever I discussed in the last exam. It is most probably the similar because I know I have done my studies while working. Only PhD I took 2 years leave. Other than that, I was doing all the chartered whatever thing while working in the private sector as well as government sector. Before joining the government sector in 2002, I worked in the private sector. So I know that these problems you are facing. Not only this subject, you have another subject assignment. I know this load, academic load. So therefore, I want to clear your mind. So thank you very much for selecting accountancy. Otherwise, I will not have a job. Last time there were 18 students. I think this time, around 13. Anyway, we will see small calculation when I use Excel sheet next day, final day. Don't worry about that. But for the time being, you can talk to your friend, go to Google and search how to calculate simple calculation. Where the discounted payback is, you get the discounted cash flows and now another techniques, profitability index. It is very easy. Now you know what is your future cash flows. You know how to calculate. So just get the future cash flow total and divide it by the initial investment. For example, earlier sum, you go and tell me the answer. Now you divided, now this cash flows 975,000. Just you divided inflows by outflows. So outflows present value is 975,000. You just divided 975,000 divided by 900,000. What is the answer? I forgot to bring the calculator, but I have the mobile. 975,000 divided by 900,000. What is the figure?
1.083.
Yeah, thank you very much. Now you see, we will accept project more than one. Profitability index more than 1, we will accept. It means now this project we can accept because we invest only 900,000. You are getting 975,000. So profitability index is simple as that. You see, profitability index ratio of the present value of future cash flows to the initial investment. And if the condition is PI, project index or profitability index, more than 1 are considered favorable. Now this is an example again, you can check. Dollar is there. Dollar, you just delete the dollar one. I think I did in the night, so I have fallen asleep and put dollar because Sri Lanka need dollar. Anyway, profitability index is very clear, very small calculation. You get the present value of future cash flows divided by initial investment. So one told me 1.08, correct? Therefore, we can accept that whatever the project, if PI is, profitability index is more than 1%, we'll accept. Right, accounting rate of return. This is, I think, not difficult at all. This is accounting terms. Right, anybody can see and calculate your leisure time. Now, this is initial investment 100,000, discount rate is 10%. So cash flows are given year 1 40,000, year 2 50,000, year 3 60,000. Bring all the cash flows into the present rate. Or calculate, we'll see initial investment 100,000, discount rate is 40,000. So just you divide 45,000, 1 divided by 1.1, now 12%, and now is 10%. 1.5. Discounting factor is 0.909. Multiplied by 40,000. Value is 36,363. You check the year 2 also. Discounting factor is 1 divided by 1.1 to the power. Calculator doesn't have power. Power 2. I think I can go to scientific calculator and see. Can anybody help me? Year 2. Now year 1 around 36,000. Year 1 36,363. Year 2, what is the present value of 50,000? I think Ganga is sending answer always. Thank you. Even though throat affection, she can type. I think your calculation is given down. I didn't see that. So you see, 40,000 value is 36,363. 50,000 value is 41,322. Year 3, 60,000 present value is 45,000. If you add all, you will end up with a 1.1 122,737,056. PI, just you ignore the dollar mark. You can divide 122,737 by 100,000. I think the answer is 1.23. Is this correct? You can check and tell me. I think again new Mr. Abdul Siraj.
Yes, sir. Good afternoon. Actually, I am on the traveling.
Right. So go home and see my presentation. Adhikari? Right. I don't know, Mr. Mandula or Mrs. Mandula, I don't know. Yeah. Did you check? I think this is correct, I think. Sanjeev? So Sanjeev?
Yes, sir.
Correct, no?
Yeah.
This is simple calculation. You will get the same sort of calculation in the exams. Nothing to do. For a finance officer, it will be a very easy sum, but engineers also can. Shall I move to the next one? Next. Now, next technique is accounting rate of return. This is very simple. The problem is this doesn't consider time value of money because purely accounting. Again, if you type ARR, this will give 100% clarification from the internet or chat GPT, whatever you use and learn. Accounting rate of return is the average annual profit of an investment over its entire life, expressed as a percentage of the initial investment. Formula is given. Average annual profit divided by initial investment into 100. So again, dollar. Simple calculation is given. Annual average profit mean project is over 5 years. Total profit 60,000 over the 5-year period. So just get the annual average annual. To get an average any calculation, so just divided by 5 years. 60,000 divided by 5 years, you'll get 12,000. Initial investment 100,000. So it is 12%. Accounting rate of return is 12%. The accounting rate of the project is 12%. If there's another project which has a 14%, so we go for that because this is a higher profit. But only loopholes or drawback is we don't consider present value, discounting factor, present value of money. So that is the only shortfall in this calculation. Because this is again giving in the rupee term or dollar term or any other currency term, not in absolute figures, so not in discounted factor figures. Therefore, these techniques are used to just to screen out. But for the final decision, definitely we have to move for the net present value calculation. So there are some examples, leisure time you go through. So it has given, I have mentioned it has limitation. It doesn't consider the time value of money. As a financial manager, as a procurement manager, you need to know the time value of money because you are investing in the huge projects as a procurement officers, supply chain managers, maintenance managers, or whoever. So for I think one maintenance manager was there in this. So for example, you are getting a huge machine. So definitely they will come up with the maintenance plan, at least for 5 years. Comprehensive warranty. But they will charge. So you want to compare two people with the two different machines. So then definitely you have to apply a net present value technique. Otherwise you can't evaluate. Right. Now I think all can calculate the present value of future cash flows. Just you use the formula 1 divided by 1 plus r to the power n. That is very simple formula. You replace the r with discounting factor, discounting rate. In the exam, definitely I will give what is the discounting factor. I will never ask how to calculate discounting factor. There is no time. So best way to apply, but very careful. So you can check any amount you are getting in the after 15 years or 10 years. What is the value of today? 1 divided by, just get the discount effect, rough idea. Now around now in Sri Lanka, interest rate is around now 10%, 10 to 12%. Usually we get the borrowing rates, bank loan rate. So 12%. If we apply 12%, 1 divided by 1.12 into the power 20 years. So the amount you are getting after 20 years, you can see the value today. Therefore, I have never go for insurance, life insurance. Why? There's a coverage also if you die. But if you don't die, you don't get any return. Even if you die, you will not get the benefit. Your siblings will get the benefit. So therefore, I don't have any life insurance. Why? I know the time value of money. When they say after 20 years, you can get 1 lakh, I just put 1 lakh divided by 1.1 to the power 20 years. Then you can see the figure. So before moving to the next, are you all clear?
Yes, sir.
Okay, thank you. Thank you for the feedback. Right. Now this is full applicable to procurement officers. Now you see, again I have put, we have a heavy, big press, printing press, worth millions. And machines are very heavy duty. So you see, now we are planning to bring a heavy duty printing machine for our printing press with 5-year maintenance cost. This is a example, maybe not practical, so not real example, but for you to understand, I have decided to put this sum. Now this is purely applying financial management techniques to procurement. Now you are head of procurement, you need to evaluate. Now heavy duty printing machine worth 1 million initial, because they can quote. We don't know. We are giving only the technical. Don't worry. I have served more than 15 years in the as a head of supply. I know these problems. So now sometimes you find identical bidders. So how do you select? One of identical bidder is your friend. So you select man, select pen. You can't do that. You are in the government, especially I am in the government. So we need to follow the rules, procurement rules. If it is a private company, of course you can give whatever you want to your friend or whatever. So now simply understand this is again in the financial terms. Now when we call quotation from bidders. So they quote. So company name X, initial cost 1 million. You see, they charge maintenance at the beginning 200, 300,000, but at the latter part of the project, they are charging high. But you add together, all three, 2 million, 2 million, 2 million. This is hypothetical situation, but it may happen also. So you can see. Now, how can tell me anybody who can advise the Open University which one I have to select with these figures? Any guess? Without going into calculation, considering the time value of money, what company is can anybody give me an idea how to solve this issue? You all are Pokemon managers. Any hint? I think Ganga is helping to others. Okay. Mr. Sanjeev, what is your idea? Mr. Nuan Veeraman? Now nobody is talking. Mr. Loganatha? சொல்லுங்க. I don't know. Nobody is talking.
Third company, sir.
Third company.
Yeah.
Why do you say like that?
The
I agree.
cost, all other company are cost like front loaded. So the risk is more than higher.
Right. Thank you. That is the thing you should, see first whether front loaded or rear loaded. If the rear loaded, it is beneficial to us, right? The basic. Anyway, now as a financial person looking at these figures, you know time value of money. Now, if you ask everything in the beginning, we know that value may be higher, cost may be higher. This is cost. This is the initial cost, the machine cost plus maintenance. So now this is, we can come to a judgment, but we need to prove exactly who is highest cost to us, who is the lowest cost to us. So therefore, to sort out this issue, Even this one I gave it the last exam paper also. Everybody attempt very well. I think all attempt. I gave this same thing, I think, for the final exam. Now you need the technical equipment to sort out this issue. Because 3 companies, if you added 5 years, the same. So in this case, you can use any discount rate, 12%, 5%, 1%, 10%, because no harm. I don't want to give you the percentage, but I gave, because now you can use any discount rate and to discount these cash flows. Your decision will not change. If you use the discount rate of 15%, you will get the lowest cost man and the highest cost man. Maybe value may be different, but your decision may not be different. So in this type of a situation, you should bring all the cash flows to the present value and then compare. Now, for example, X 1 million, you get 200,000 into today's value. Year 200,000 is to today value. Year 300,000 to today value. Year 4, year 5. Then you compare. I think answer you need to work out. Can you all work out now? This is very simple. Don't find all the discount rate for all the 3 companies. One company you find the discount rate. One time you can apply. So you no need to change the initial cost. Keep all those initial costs. Only discounting factor you multiply by 1.12, right? I hope all are working, because this is the time you have allocated. Because when you go home, when you go back to the office, you will never have a time to do this. So during this time, better to understand and do it and keep it in mind for the exam. Now, you can write down the discounting factor on the year 5, year 1 to 5, and then multiply it by that discounting factor, each finance figures, and then come to a conclusion. I don't have the answer actually. That's why I picked the next button, but no. Finish. So discounting factor for year 1. I think you can use the same 12%. Now, usually you should put the discounting factor at least 4 decimal. There is another rule. So year 1, it is 0.8928. So you can use the same rate for 3 companies, no issue. Give me a small break, 10 minutes, 10 to 15 minutes. Hello? Who is it? After short break? Mr. Sanjay,
Yes, sir.
yeah, I was disconnected. I had a short break, but disconnected. Now, can you see?
Yes, sir. We can see.
Right. Now, shall we do together then? Already finished? Can anybody tell me the answers? Access. What is the value of the 200,000? 1 million. Shall you all get together? Oh, what is the value of the year one? X. 200,000. One point one divided by 178,571. Okay. Second year. Beta year one 267,857. $44,642. Chance. We will move to the year two. Year two discounting factor. Now, so earlier discounting factor, again you can divide it by 1.12. Then you can get the No need to do just divided by 1.12. Can anybody tell me the discounting factor for year 2? Anju, what is the discounting factor for year 2?
The
What is that?
0.7972.
0.7972. Right. So you multiplied that using 3 cash flows. 100,000 into 7.7927, huh?
7972.
7972. Right. Sorry. 7972. You need multiply by 100,000. 0.7972. 79,720. Next, 300,000. 239,160. Again 100,000. You see, company is different, but no need to calculate again. You can just put the figure. X also 100,000, chance also 100,000. Why you are gaining? No need to increase, multiply. Just use put the figures. 7 shortcut. Year 3 also same. Huh? In the exam, don't calculate each and every figures. The similar figures are there. No problem, you can change. What is the discounting factor for year 3?
0.7118.
0.7118. Thank you. I am also doing the sum. In the year 3, 100,000 is there. First company X 100,000. 100,000 into 0.718. 71,180. Next one, 200,000. You divide, now you just multiply by 2. 142,360. Apply the same. for the chance company also 142,360 because the cash flows are similar. Discounting factor for year 4?
0.6355.
0.6355. Thank you. 300,000 multiplied by discounting factor 0.7355. 190,650. Again, you see, chance also 300,000. You put the figure chance also 190,650. No need to calculate again. But 100,000 is there. $63,550. This is for the second company, beta. Third company, chance. Yeah. Discounting factor for year 5.
0.5674.
0.5674.
5674.
So use that discounting factor to convert the cash flows into net present value. 300,000, you have to do 3 things because no similar cash flows. You just 300,000 multiplied by discounting factor for the year 4, 5674. 5674. Actually, this is the sum I gave in the last exam. Next, 300,000 multiplied by 0.5674, 170,220. Then 50,000. Next company 50,000 into 0.5674, 28,370. You can multiply it by this 28,000 into 5 because 50,000 into 5 means 250,000. No need to put 250,000, but by in the exam, I saw most of the students, they have calculated twice, wasting time. So you can multiply cash flow for 50,000 into 5. Don't worry, you see, and the same answer will come. 141,850. $28,370 into 5, 141,850. Same answer. Okay, what is the X total? 1 million. Now we are going to add, because now cash flows are similar. We can add because all future cash flows are converted to the present value of today. Now all the cash flows for three companies bring back to the present condition, today's context. So then you can add it to the initial cost. No harm. Because otherwise, all three companies are 2 million. To whom I should give? You can put the tree name and ask them to select one. So that is the possible another way. Like raffle draw. So company X, initial cost 1 million. I have a calculator now. 1 million plus 178,571 plus 79,720 plus 71,180 plus 190, 650 plus 170, 220. Please write down those who are not calculated. 1,690,341. If I am wrong, tell me. 1,690,341. Correct? Wrong. Sanjiva is correct? Mr. Nuwan Viraman. I don't know whether you can hear me. Miss Ganga? Okay, chat box. Yes, correct. Okay. Now the cash flows for company X company total 1,690,341. So we move to the second company Beta. Initial cash was 1,050,000. 1,050,000 plus 267,857 plus 239,160. Year 3, 142,360 plus 63,550 plus 28,370. 1,791,297. Little bit high. If anybody is not getting the figures, please tell me. I am going by one because this is very important. Sometime it may be repeated in this exam also because easy to calculate. So without putting you into big trouble. So, but make sure to calculate. Accountants, I know this is very simple. Engineers also may be simple, but I don't know others. Because you are not used to do a calculation like this at this age. You all are senior managers. Therefore, actually, please don't wait until the exam day to calculate. Then I saw one or two putting figures and here and there, and then you can't add it also. because you are not used to do that. Therefore, this calculation need patience and concentration. Sometimes you might see all the figures are same because eye vision also after 40. Right, last one, chance. No chance. 1,100,000 plus 44,642 plus 79,720 plus 142,360 plus 190,650. Right. Last year 5, 141,850. 1,699,222. Which one we have to select? Now tell me, all are big people in the procurement divisions. With whom we should enter into the agreement to buy a heavy duty printing machine?
X.
X. So you see, now if I don't have a technique like this, you have to do a raffle draw or whatever, put the 3 name, put up and catch, ask them to catch one. So this is not allowed. So I think I also calculated because I need to see all are calculating this because I know you are very busy people and especially supply chain management and supply maintenance. Always you are required to attend. We can't wait. So anybody is not clear? Or silent? Can I go back one by one? Even that not talking. Right, first one, I don't know, there's a 7057 October 2024. Who is this? The participant name is 7,557 within bracket October 8, 2024. Feedback is very important. Can't talk. Okay, Mr. Abdul Siraj.
Yes, sir. I'm here.
Clear?
Yeah.
Yeah, on the way or now you reach your destination.
Reach to office again.
See the problem. I know that busy schedule, but make sure to calculate this mathematics with this sum, okay?
Yeah.
Okay. Again, Miss Ganga, I think can't talk because throat affections. Did you understand? At least send a message. Okay. I'm looking chat box. Sir, yes. Okay. Thank you. Mandula. Can't talk. Okay. Mohammed Subani.
It's clear, sir. Got the same answer.
Okay. Now you can use this type of a calculation for the evaluation.
Yes, sir, of course.
Okay. That's what I want. I don't need to be a expert on financial management technique, net present value, how you create this formula. No need. Just apply.
Just a basic idea, yeah.
Okay. Right. Thank you very much, Mr. Subani.
You're welcome, sir. Thank you.
Okay. Mr. Modida.
Yes, I understood. Yes.
Yeah. You can apply in your settings. If the case come to this type of similar case, you can use. Mr. Nuan Veeraman.
Yes, I understood.
Okay, thank you very much. Because this is the first day, my camera is also not working, so I can't see you, so you can't see me. So next time I make sure my camera is okay, because I am not a technical person to fix it. Something has happened. Otherwise, I am keep it open always. But I know participants are not visible. It's okay. Mr. Sanjeev Dishanayak, I think you work some and with me.
Yes,
Mr.
sir.
Sanjeev?
Clear. Yes, clear.
Clear.
Yeah.
Right. Thank you all. And this is the pattern I am using. So you can see out of financial management subject, I have checked only simple calculation, net present value calculation in the exam. Because you are doing a master, if somebody asks what is NPV, you should give the correct answer because you are a professional. You can't ask from somebody else, right? So therefore, most important technique I have practiced with you, I have sit with you and calculated, and please ask your friend to do that. And I will never ask any technical questions from you all because only one or two having tech accountancy background. So it is not fair to test highly technical matters. The accountant, you have to bear with me because for them it is a simple calculation. I know that because I am also, I told you, I am also chartered accountant. So I know the capacity. But in the exam, what I mean, you have to use your knowledge, technical in the practical field. That's all. Right. Now, so Ganga has asked a question. This is like total cost of ownership. Yes, this is like that because you need to pay maintenance cost because it is fixed. It is not probable. Definitely, they will put the figure maintenance, how much they require during next 5 years. Definitely. As one told, you can upfront or you can charge at the end. Fully loaded, or I don't know, whatever use. Front load mean you put whatever the money at the beginning. For example, initial cost chance has front loaded 100,000 than the others. So likewise, I mean, so this is a typical situation. But in my life also, I have done procurement for more than 12 years. So then we have come across one day, it is 100% tally with the BOQ and the bidders one. No any single cent difference. That also might happen. Surprisingly, you open the official estimate and when you open the bids, 100% tally with our BOQ. I was surprised because I was not doing that job by another maintenance administration did that. I was one of the technical evaluation committee member. So at the bid opening, we found that. So similar thing can happen. Now people, companies are fighting to offer you a deal at a lower cost, but they charge from toners, parts. So for that also you should have a strategy, because otherwise they will come and tell 1 million machine at 100,000, but toner 50,000. You can't buy 2 toners. So that strategy they are following from their side. So from our side, we need to be very careful. So do whatever you want to identify total cost, ownership cost, or whatever you mean. This is the total cost to the organization, because you have to pay at the beginning 1 million for we select tax. So we need to pay 1 million at the beginning, and then the maintenance cash flow for the year 5. 1, 2, 3, 4, 5. But you see, I guess that X will be the lowest. Why? You see 300,000 in the year 4 and 5. They have not front loaded. That's why he became the lowest. Okay, in terms of financial management techniques. Right. You all can ask any questions? Any doubt with regard to the accountancy paper? Because this is not familiar subject to you. You can ask any questions, any clarification. This is the first day, whether you understood, whether you can understand my speaking, the way I pronounce. That may be new to like those who are in Saudi Arabia. I don't know whether my pronunciation is clear to you, so I can adjust. I'm a little bit fast because right brain man, so then that is the reason. Okay, now open for questions. Already left. Mr. Loganathan?
Yes, sir.
No, any issue?
Yeah, I have got it. Everything.
Right.
Okay.
Let's go. So this is the first day. Actually, we don't teach full time during first day only, but we have a very tight schedule. I think 3 subjects I have only 3 days. So 3 days also 3 hours. So huge subject to be taught in simple way within 3 hours. Very difficult task. Very difficult task. So that's why I want to make sure whatever I said and done, which it is being inculcated to your body, your memory. Because why I am emphasizing the practical application. That is you should know. You know, as I told you, you don't need to create formulas, find financial techniques, tell the pros and cons of the financial techniques. That is, I don't expect highly technical matters. So simply use and understand. Please, when you say budget, if it is officer from Sri Lanka, so you should know what is our budget total, what is total income, total cost, total surplus. So something like that. What is the export revenue. It's common sense as an executive. How do you see this sum is difficult for the exam?
I think it will be not a difficult question, sir.
Difficult?
No, it is not a difficult question, I think.
Yeah, that's what I'm asking. Because I have to set a paper which is there should be standard in the paper also. Then there's another problem. If I don't put at least technical thing in the paper, that again is a question, because somebody else can read the question paper for public accounting and finance. This is under investment and project AFPA. So this area is a huge area. I can teach 1 month, one technique. but therefore, that's why I am not putting the tough thing into the paper. I think it is very easy for the accountant. I am telling. But when you come to other areas, because this subject is divided among 2 experts, there are other resource person also setting the question paper half. I am putting half, or I am putting 60%. He is putting 40%. Well, my weightage is a little bit high. So then thank you very much for listening and responding. Please respond. Don't because it is help for me and help for others. So because your response is keeping me alive also. If like a dead one party teaching, I don't like. This is a very practical subject and we can discuss, talk about. And I told you also a situation in Sri Lanka. But when it comes to other country, they also can think about their country. What is the revenue total budget? What is the budget forwarded to the parliament in any government? So I hope that I'm very clear what I am telling you all. So I will try to be slow down a little bit because I'm usually very fast, but I purposely thinking and talking very slowly. Right. Good night, and we'll meet the next day.
Thank you, sir.
Thank you very much, all.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you. Thank you very much.
Thank you.
Thank you very much.